Something just happened in China that should not be happening in a normal market. And when I saw the number, I stopped everything. Because while the West was pricing silver at $88, Shanghai opened at 99, not 90, not 92, 99. That is an $11 gap between two parts of the same global market. The same metal, the same day, the same world. And most people will hear that and move on. But if you understand what that actually means, you realize this is not just a price difference. It is a warning, because markets do not separate like this unless something underneath the surface is breaking. Shanghai did not just open high, it exploded. Within minutes, silver pushed to $102 per ounce, 3 digits. Let that sink in. Silver was trading above $100 in one of the largest physical markets on Earth. While the Western financial system was still pretending it was worth almost 15% less, and then something even more interesting happened. It closed at 96. Still $10 above the West, still massively disconnected, still sending the same message. Physical demand is not agreeing with paper price, and that changes everything. But because this is not random, this is not noise, this is structure. Just days before this happened, recyclers in Shenzhen were already offering massive premiums just to secure physical supply. Not futures, not contracts, real metal. They were bidding above exchange price before the exchange even opened. And that tells you something important. It tells you demand was already there, waiting, building, pressuring the system from underneath. And when the exchange finally opened, price adjusted instantly. This is how real markets behave when supply becomes tight. They do not move slowly, they jump, they gap, they reveal the truth all at once. And while this was happening, something strange was happening in the West. Nothing. Volume slowed, price stalled, movement became quiet, almost frozen. This creates a dangerous situation, because when physical price and paper price diverge, one of them is wrong, and eventually the market is forced to decide which one. Now here is where the situation starts getting even more serious, because while price was disconnecting, volatility was exploding. The comex implied volatility index just hit 100 and that 34. That is not a normal number. That is a panic number. For context, volatility did not even reach this level during the last historic silver spike. Volatility is the market's way of saying something violent is coming. Not maybe, not possibly coming. It is the options market pricing in instability before the price itself reflects it. Think about that. Price looks calm, but underneath, the system is bracing for impact. This kind of divergence does not last long. Eventually, price catches up to volatility, not the other way around. And then something happened in Shanghai that confirmed the pressure is real. The exchange started suspending trading accounts, not one, not two, 23 accounts suspended in a single month. The exchange itself confirmed this. This was not a rumor. This was not speculation. This was enforcement. Accounts were removed for violating trading rules. That tells you something important. When exchanges start stepping in at this scale, it means activity is becoming disruptive enough to threaten normal operation. Because exchanges do not act unless they have to. They do not interfere unless something forces their hand. And this is happening at the same time physical silver is trading at massive premiums. At the same time, volatility is exploding. At the same time, global demand continues rising. These events are not isolated, they are connected. And then you look at the settlement data. This is where the pressure becomes mathematical. Right now, there are roughly 188 million ounces of paper silver approaching settlement, but only 88 million ounces exist in registered deliverable form. Think about that imbalance. More than double the claims compared to actual available supply, 2 claims for every 1 ounce. This system works only as long as most participants accept paper instead of physical delivery. But when physical demand increases, the math becomes dangerous because paper promises cannot deliver real metal if enough people ask for it. And this is why the clock matters. Settlement deadlines are approaching. Positions must either roll forward or stand for delivery. And if delivery demand rises while supply remains limited, pressure builds instantly, not gradually, instantly. This is how stress enters the system. Quiet at first, then suddenly obvious. Now there's another signal forming that almost nobody is talking about, but the people who understand commodities are watching it very closely. It is called backward allocation. Normally, in a healthy market, future prices trade higher than current prices. That makes sense. Storage costs money. Time has value. So the future carries a premium. That is normal. That is stability. But when the opposite happens, when the present becomes more expensive than the future, the message is clear. The market does not want silver later. It wants silver now, immediately, too urgently. Because something is telling buyers that waiting could be dangerous. Right now, the spread between March and May futures is getting closer to that point. It has not fully flipped yet, but it is approaching, And when backwardation appears in a physical commodity, it is one of the strongest signals of supply stress that exists, because it means physical metal is becoming more valuable than paper promises. This is not theory. This is how real shortages begin, and this is not happening in isolation. At the same time, silver is showing stress. Oil is moving higher. Crude just climbed to levels not seen in months. Global discoveries have been falling for years. Supply is tightening, and when oil rises, it feeds inflation. When inflation rises, precious metals follow. This is how macro pressure builds, layer by layer, signal by signal. And then you look at what is happening in Asia. India just reported another record month of gold imports. Not average record. China continues absorbing physical metal quietly, consistently, without headlines, without attention. This is important because Eastern markets focus on physical ownership, not speculation, not leverage, ownership. They are accumulating real assets while Western markets continue trading paper, representations. This creates tension because eventually physical reality overrides financial abstraction. And when that happens, repricing is not optional. It becomes necessary. But here is where honesty matters. Shanghai did not hold 100. It hit 102 and then closed at 96. That tells you something else is happening too. There's resistance, there are sellers. There are participants willing to exit positions at higher prices. This is not a straight line. It is a battle between demand and supply, between paper and physical, between perception and reality. And battles create volatility, not certainty. But to really understand why this is happening, you have to zoom out beyond silver itself, because this is no longer just a silver story. This is a global capital story. Money is moving quietly, deliberately, from paper into physical. You can see it in gold, you can see it in silver, you can see it in commodities across the board. And the timing is not random, because at the same moment, silver is showing stress, geopolitical risk is rising again, oil is climbing, tensions in the Middle East are increasing, supply chains are becoming fragile. And whenever uncertainty enters the system, capital looks for safety, not promises, not contracts, assets, real assets, physical assets, because physical assets cannot default. They cannot be printed, they cannot be created instantly. This is why central banks have been buying gold at record levels, not selling, buying year after year, quietly preparing, and silver follows gold. Always has, but silver moves differently because silver is smaller, more volatile, more sensitive to sudden demand shifts, which means when pressure builds, silver moves faster, more violently, more unexpectedly. Now combine that with what is already happening, Shanghai trading above Western price, exchange suspensions increasing, volatility exploding, settlement pressure building, physical demand rising. Each one alone is important. Together, they are powerful because markets are like pressure systems. They absorb stress for as long as possible until they cannot. And when that point arrives, release is sudden, not gradual. History has shown this again and again. Most of the time, nothing happens. Then everything happens at once, and the people who are only watching headlines are the last to understand why. So now step back and look at the full picture. Shanghai is trading silver at a massive premium to the West. Volatility is at extreme levels. Exchanges are suspending accounts. Physical demand is accelerating, and settlement pressure is building against limited supply. These are not normal conditions. This is what structural stress looks like in real time. Because the system was built in the assumption that most people would never ask for delivery, most people would accept paper, most people would trade numbers on screens. But when physical demand rises, that assumption becomes fragile, and fragile systems do not break slowly, they break suddenly. The gap between physical price and paper price cannot stay open forever. Eventually, one of two things happens. Either physical demand weakens and price falls, or paper price rises to meet physical reality. That is the resolution. That is the mechanism. That is the moment everyone is watching. And right now, the pressure is not decreasing. It is increasing. You can see it in the volatility. You can see it in the premiums. You can see it in the global accumulation. This does not mean price goes up every day. It does not mean volatility disappears. It means the underlying structure is changing, quietly but permanently. This is how repricing begins. Not with headlines, not with announcements, with data, with pressure, with imbalance. Most people will not notice until later, until the move is already visible, until the new price becomes normal, until the opportunity is no longer obvious. But the signals are already here. The market is already speaking. The only question now is how long it takes for the rest of the system to respond. Because when physical and paper stop agreeing, history shows the resolution is never small, it is decisive, it is permanent, and it changes everything that comes after.